Ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered. I've been in this business since '69. Most of these Harvard MBA types, they don't add up to dog shit. Give me guys that are poor, smart, and hungry. And no feelings. You win a few, you lose a few, but you keep on fighting. And if you need a friend, get a dog. It's trench warfare out there, pal.
It's the weekend once again. It's almost mid-morning on a Saturday, and we are back for another weekly market recap. Welcome back, y'all. Now, the week that was, it depends. I mean, many different assets actually moved. I think the most flat, relatively speaking, was the equity market. But maybe because the focus were all shifted around with, this memorandum of understanding finally being signed, although online. And then, at the time of this recording, they are setting up a meeting in Switzerland to keep on discussing terms and other parts of the agreement in order to push it through, although, still out there in limbo. It just takes a tiny little thing to blow it all. So who knows? And the other focus, the other main theme of the week was, of course, FOMC with the first press conference with the new Fed chair. So, if you look at the economic calendar, there wasn't a lot this week. I mean, even if you check the rest of the world, we got BOJ deciding on interest rates, and I think they hiked, 25 basis points it looked like. And then RBA down in Australia, they did what? Nothing, they paused. So, as for the US, which is what we usually focused on, we got retail sales, which this time around, I have to say, they came in positive enough. You see a nominal 0.9%, so almost 1%. But, inflation month-over-month, the CPI for the month of May came in at 0.5, so 0.5. So again, even adjusted for inflation, these data out of the retail sales, it looks like a good one, all right, for a change. So, all right, then what? We got jobless claims, which again, it looks like they're attempting these bounds, so to speak. But, kind of the same of last week. We are still basically at the median of the last 3 years, so nothing to see here yet, in my view, right? Same for the continuing. They were going down. Is this some sort of a huge bounce? I mean, maybe, but we kind of saw something similar in here, right? It is tried to come back higher for what? A few prints, and then it collapsed it back lower. So I wouldn't put a lot of weight on these, data right here. Both jobless claims, the standard one and the continuing one. So, not a lot for me there. Credit spreads are still particularly low. They had that little bit of an uptick in the previous days and last week. And then, this week they came back lower. So another one, nothing to see there. I'm not going to cover for now inflation, break-evens, or the Fed Watch tool, but we are going to revisit them later on because the majority of this video is probably going to be around, I guess, oil, yields, and the old talks about the FOMC and what may come out of it in the future. So, I think it's just really worth watching the charts for now and coming back to these topics later on, trying to integrate them in the video with live charts, all right? As for the charts, let's start out as usual with the DXY, which, look at that. I mean, we keep on having these sideways up. And I mean, this time, it may conditional. It's you have to use it because it may look like we are breaking out of this resistance. I mean, again, we were looking at this area in the past 1, almost 2, 3, 4, 5, 6 times, and then a 7th time in here with a little bit of a rejection. But we didn't really had a lot in the sense of the rejection. We just came back to visit previous established or created support or freshly created shelf, and we used it as a launchpad to keep on bouncing higher. And especially these 2 days, so Wednesday, the day of FOMC, and then Thursday, a little bit of a continuation to the upside. Very sharp move, this one, for the DXY, right? And on a Friday, I think it may have been as well a little bit of a profit taking, especially if you consider foreign currencies, which of course dumped. So, again, the more it keeps on going, the more it looks like a long process of rounded reaccumulation. Now, can these be completely fucked off and dismantled? Yeah, absolutely. All it takes is some piece of headline which send the DXY, well, kind of this way, right? Either back in the range or targeting the other side of the range. And again, you know what I think about ranges. They work up until the point they work, right? And then you need to consider that from time to time, you could see price try to escape out of them. And then again, the game begins. Is it a true breakout, or it's just some sort of a deviation out of the range, and then you have mean reversion, right? So for now, again, don't think about that, because I mean it is something that, even if you imagine some sort of a attempt of running away and then some sort of a fake out or a fade of these move to the upside, it may take another month to manifest itself. So for now, what's relevant to register is that we are having this attempt higher. And again, it was, kind of in the cards because of the way price was moving up. And if you look at this entire structure right here, right, this entire range, almost a year, if not a bit more than a year of price action, and then, you look at these recent segment of price action, it's basically the same, right? Is the market trying to go down? No, it's rejected higher, and then it goes sideways, it tries again, no, goes higher, it tries again down, no, goes higher. And it's kind of the same in here, right? Tries to go up, it's rejected, but then again, tries to goes down, no, doesn't, bounces. Another attempt down, bounces higher. And then from here, you see this pattern developing of sideways higher, sideways higher, sideways higher. So efficient market to the upside, orderly moving. So, got to respect that, right? So in comparison, if you look at foreign currencies, of course, the euro, the pound, they all went down essentially this week. Now, we, at least for now, we didn't break these lows, both in the euro, which should be around what? 114, let's call it 114 even, right? Just to take the big figure as reference. And for the pound, 131 and a half, let's call it. That would be an area of support which you don't want to violate if you want to keep on being bullish the British pound, or in this case, the euro, right? I don't have a very strong bias on these ones. If not, sure, for now they look bearish. But again, bear in mind, we have been moving, again, same as the dollar, we have been moving in this range for the euro and the pound for the same time span of the DXY, right? So still a macro range, so to speak, and up until the point I don't see them breaking one way or the other with a very sharp move and decisive move where you can really see that attempt of really driving price away from those current bulk of volumes. I wouldn't read a lot into it for the long term, but yeah, of course, in the short term, intra-week, intraday, there are certainly movements that you can capitalize on. What was that? Oh, dollar Canadian again. Looks like that was a break, retest, and confirm support and resistance flip, and we really went lower. Probably even because we had rates being decided in the US, and at the same time we had rates being decided in Canada. So I guess that might have played a little bit into it. Although I think in Canada it was last week, not this week. But anyway, the market was just trying to price that in, I guess. Or at least it could have been something which, when combined, just exacerbated a move which, was already kind of brewing, if you look at that. What else? Japan, so the Japanese yen. How about that 160 level? Once again, we are there once again. And actually, we're a little bit past that now, 161. All right, so interventions, yeah, sure. And then you hike rates, as we've seen in here, right? See, Bank of Japan, they hiked. I mean, do you do it because you think somehow that interest rates differential may help you? You know, you're keep on hiking while the Fed it's keep on posing. So you may hope as the BOJ that you could attract a bit more capital, yeah, and then those pesky speculators are still shorting your currency. Is that the story? Because when you see something like that, and those bureaucrats are often kind of put on the spot because what are you doing? Why your promises are not working anymore? Well, it's because of those pesky speculators, right? Yeah, is it? Or it's because there is something systemic which is not going your way. So again, I think, as I've always said, the market will always be more powerful than the central bankers, right? And in some places, more than anywhere else. Like Japan is a good example, or the Turkish lira is a good example, or Argentina may be a good example, right? So, not all currencies are created equal, and each and every one of them will have the distinctions, the characteristics, and the fundamental backdrop. But again, at the end of the day, it's still a decision that the market has to make. It's not about central bankers. No, at this point, I don't believe anymore in central bankers. And if you're gonna stay a while, I was thinking about at this point. Probably I should do it. I will just replay 5 minutes, 2 questions that were kind of asked to Kevin Warsh throughout his first press conference, and most likely we're gonna have a laugh. All right. But for now, let's move on and let's look at the others. So Chinese yuan, nothing to say, still doing the same. South African rand, still the same. Russian ruble, expanding, or at least, probably continuing this pullback, because we had the initial pullback in here, bounce, but the bounce didn't make new highs, was sold off once again. So either it's going to trade in a new dealing range, or we are going to trade a little bit back lower. My base case would be for a little bit of a range in action, but we'll see. As for the rest, Australian dollar, broke down, bounced. Nice spot for a bounce. Previous, inverted point of release to the downside. So bounce again. Comes back up into this clean breaking point in here, and it's rejected. So again, it's now in between these two levels. So I would lean, of course, a little bit more bearish, considering where it's coming from and how it's coming from it. So probably I wouldn't rule out the possibility that over the next 2-3 weeks we're gonna see lower, like this level right here. Again, I say 2-3 weeks as like top. If it doesn't happen over the next 2-3 weeks, then I would change what I think. But I mean, as far as I'm concerned, it could happen next Monday or Tuesday, right? I'm just saying I would expect it to happen in a relatively short amount of time, right? Then what? Brazilian real, this rejection at this level right here. So the bounce at the end of the day was faded, kind of like in the ruble. They are all looking the same, right? If you just look at these segment of price action in here, or in here, or in here, they're still moving the same altogether, right? Strangely enough, or should I say strangely? I mean, I might say counterintuitively, but the Indian rupee, after taking the shit for weeks now, it looks like it's really trying to put together something which resemble a low, and we will see if it's going to be a short-term or long-term low, but they're really putting in the effort, right? Now, I think most of it, let's say at the end of the day, this is some sort of a low, right? It's a bottom, although we'll see how good it will be, or for how long it will be the bottom. But let's say it is. I think the main reason, the main responsible, the main catalyst for a bottom to be put in at these levels this way, it's going to be oil. Because I think India, same as Japan, they were hit a lot by this energy crisis. Although India, on the economic side of things, and fundamentally as a country, it's holding up way better than the Japan, which is why, if you strip out the only reason which, in my view, was the cause for this drop, they could see the currency rebounding a hell of a lot better than the Japanese yen. So I would say if oil keeps on drifting lower, or at least staying, in a new range in between, 80 and 70, and potentially kind of tapping below 70 for a little bit, we may see these bounce in here being extended on the India rupee, right? Other than that, let's close the chapter on currencies and let's have a look at Bitcoin, which, again, quite honestly, it didn't do a lot, right? Yeah, sure, we were looking at this bounce, right? Looks like the bounce now has been faded a little bit. Now, this is interesting because, on the way down, right, I was looking at this level, I think it was this one, yeah, as potentially an area of support. Now, didn't offer support, obviously, but if you look at the entire structure, it would have been this one, right? So basically, this pocket of liquidity, this accumulation before the run up, right? So, if you watch past the simple level, right? But if you identify the entire thing, which was, in my view, kind of indicating anticipated support, or at least a tiny bounce or an attempt at a bounce, it would be the entire area. So now it looks like, if you expand it out in time, we just came back into it. And again, if you deemed the area as anticipated support and it miserably failed, now again, another dynamic as support and resistance flip. So you could see the price now getting back in here, wasn't support, and now we are treating it as resistance. Although, again, I'm not saying this is it and now we are going to go lower for sure. I'm just saying it may be difficult. Let's say we keep on climbing higher. It may be difficult to chew through this area now, right? So again, can we see another attempt in this area here and probably another rejection initially? So again, all I'm saying is that if you think we put in the bottom in here, I think this area will be a little bit hard to chew through, right? So something like this before maybe filling in this gap right here, right? That's it if you want to be bullish, right? If you are looking at it from the bullish case scenario, so to speak. Now, again, if you look at it from the bearish side of things, you may say, okay, you know what? Now, all that I need to do is just watching this area right here, right? Because, if we bounced, all right, and then this area, it's really a support resistance flip. As soon as you see this area below failing, you open the door for a much large drop, right? Quite honestly, especially looking at the other markets, again, same as last week, I'm not having a clear bias on anything right here, right now. At least, on a short-term base, so for next week. Now, if you ask me, well, what about a month or a quarter? Yeah, okay, we could talk about that. But again, the video may be like 3 hours long, so we keep on taking things one step at a time, 1 week at a time. I would say for next week, probably something like this. Another tiny bounce in here, and then, we decide what type of a high or low we want to take out. This one, right? So another high, or do we take out this one? Right, so again, I wouldn't make any major calls up until the point we take out one or the other, right? That would be the indication for me. So not a lot to say about Bitcoin, unfortunately, this week. If anything, you're looking at all the debate about Michael Saylor, which 2 weeks ago, I think it was, strategy sold what, 4 Bitcoins, and now they're talking about the entire company. They're talking about strategy, of course, coming down. and being basically entered a debt spiral. I don't know. I mean, I'm going to be offensive most likely, but I think at the end of the day, what strategy is, and again, I could be massively wrong, right? So don't don't shoot the messenger. I'm just trying to explain which type of view I'm embracing compared to the other, because there are two views, right? Either this is the best financial engineering, infinite money glitch ever created, and therefore this is going to go up and up and up and up, or this is the biggest scam ever, aka a pyramid scheme or a Ponzi scheme. So again, at this current moment in time, so June the 20th, 2026, as I was for all the past year and some, I think I would pick the latter. This is a Ponzi scheme. All right. So I'm sorry if I'm going to offend some highly sensitive Bitcoiners or believer in the cult of Saylor or Bitcoin, but this is how I see it, because basically you are collecting money and then doing what? Buying an asset, which would be this one, right? Hoping this asset keeps on going higher so that you could, if you need it, sell and collect more money by selling either more equities, which would dilute the current holders, or selling more bonds at higher yields to attract more capital. But, that works on the premise that the underlying, which constitute the majority of the NAV, the net asset value, keeps on going higher. So again, for me, strategy, the way they structure it, it's just the greater fool game. And don't get me wrong, I think 90% of the market, it's the greater fool game, but strategy and Saylor, they took it at a whole different level. Now, I know that just because, as we are seeing now, Stretch, it's trading below par. I think it was, 85 at the close. It should be 100, right? Being a bond, being a treasury, so to speak. It doesn't mean, it happened in the past, right? It's not the first time that happened since when they were established. It happened another 3 times. And at the end of the day, it came back on par, sure. But, it is also true that previous times Bitcoin was still going up. So, I mean, you got that at least. Now Bitcoin is going down. So, again, on the other side of things, you should say when it comes down to strategy, would they be out of the market like in a month? No, they got a lot. I mean, if you think, I think they have billions in Bitcoins. So the question is another though. Let's say for some reason the stock keep on going down, right? All right. You still have to pay the coupons, 10-11% on those. Let's call it bonds for the sake of it, but the Stretch and all those things. All right. So if you're not producing any money in terms of cash flow, because what type of revenue is it? It's strategy producing. What's their core business if not being a crypto treasury company? All right. So you're just counting on more people coming in and putting money in. If that mechanism stops, right? Yeah, sure. You may say your asset side of the balance sheet is enough that you have the money to pay the coupons for, I think they said 34 years. Sure, with Bitcoin at these prices. And assuming that those yields that you're giving out in order to attract that capital will remain the same. But if your stock goes down, if Bitcoin keeps on drifting lower, and if you need to issue new bonds at higher yields to attract capital, that runaway that you are saying you have of 30 and whatever years, it's going to shrink relatively fast, in my view, all right? Because, your asset value, your asset side of the balance sheet is shrinking. And again, if you get to the point where you need to liquidate your Bitcoin in order to pay the coupons, you're just adding fuel to the fire, because now you need to sell even more because your net asset value is going down while you sell the assets in order to keep on paying the coupons. So I get the argument about the debt spiral, I just think we are not there yet. I mean, it's like every YouTuber out there, they come up with a video, they come up with a thumbnail, and they try to bring up all the meta like it's going to happen tomorrow or next week or next month. The entire entertainment game on social media is based on creating this sense of urgency. So, I mean, I'm kind of in the middle. I think at the end of the day, is it a Ponzi scheme? Yeah. Is it going to go bust tomorrow? No. Right? I mean, think about Bernie Madoff. He actually endured quite a bit of things in markets and very difficult and rough times before eventually going bust and unfolding itself for the scammer he was. So, you know, never underestimate the magnitude of this shit keep on going. Because at the end of the day, up until the, people believe in that, yeah, it's going to stay alive, right? So, you know, just a tiny parenthesis on just to really rev up a few people here and there. So if you have to, please offend me in the comments. So, I mean, at least it's good for the video, right? Let's move on. Let's have a look at gold instead. I mean, it was a nice bounce at the very end of the day. As I said, I was a buyer spot at 4,070, 69, 68, whatever it was. And again, it went as planned. It came back up into the 300s, 350s, and then it was just faded. I mean, for me, it was an easy trade, at least to play this part of the bounce. And then again, I took majority of the profits, and the remaining of my position with, at that point, it was like 25% of the original was taken out when we took out this low, Wednesday low. And, you know, for me, it was pretty simple. I mean, look, we had this gap, right? We fill the gap and we bounce. If it's going to stay bullish, I'm going to keep my 25% remaining. I want to see this bounce keep on going and creating continuation and creating a new high and potentially coming back up, testing this apex right here, right? Instead, you know, the move was all well and done at these clean breaking points in here. So, you know, I can accept, since I have a very good entry, I have very good seats for this concert. Yeah, I can accept the fact that I'm going to leave through this tiny bit of gap fill, but then, you know, if the market fill the gap, bounces, and then it's faded once again, there's no reason to expect a new bounce in here, and I want to be taken out, which is still in profit. At the end of the day, it's just a little bit less than what it could have been if I would have collapsed the entire position at these levels. So be it. I mean, sometimes you just have to play the game, and, you know, at the end of the day, it wasn't bad. I think the average return at the trade was like 5.35, 5.44%. So, I mean, not bad. All right. Why is it selling, you know, why it's being sold off once again? Well, I mean, again, technically, it was still a bearish market. Lower highs, lower lows, so it's just trend continuation. So the catalyst, I mean, if you necessarily need a catalyst, the DXY shooting higher for me, all right? That would be the catalyst for selling gold. Again, I don't want to repeat the entire story, but DXY up, foreign currencies down, right? That means it costs you more to acquire dollars to keep on, you know, keep the machine spinning, since the majority of the debt, funding, it's made in dollars, right? And you need dollars to service dollar-denominated debt. So if that dollars are harder or, you know, more expensive to acquire, you're going to need to sell what? Your reserves, so either your treasuries or your gold. So I think it's a matter of liquidity. Liquidity is being sucked up by the dollar, and I mean, again, we are coming off of a week where we got SpaceX IPO and all the rest. So, you know, it's just, I might say that all these mega caps IPOs, they're going to suck a little bit of liquidity and flows out of other assets. Because look, at the end of the day, the money out there, right? if they are all allocated to something already in whoever portfolio, if there is something new on the block that you want to buy, you need to create space for it. No pun intended, since we are talking about SpaceX. But yeah, I mean, you need to sell something in order to get the money to then go and buy the IPO you like. So, I mean, that could be another contribution to what we've seen, you know, in metals and Bitcoin and whatever, right? But mainly, I think, as many other things, most of the times it's a dollar story for me, right? Other metals, what do they do? Kind of the same. So yeah, essentially the same. Drop, pull back, and even silver, these clean breaking point in here, rejected. Palladium, a little bit of a much more extended pullback to the upside, but then again, it came back in the same type of balance it was, and it was rejected. So, yeah. Copper, right? Nothing to say about copper. Still going sideways. Still, you know, hanging in there better than anyone else when it comes down to the metals we look at. And again, we have been saying for a long time about the fundamental stories and factors and drivers around copper, AI infrastructure to be built up, re-electrification of the world. All right, so, you know, there's no need to repeat. All right, now let's have a look instead at oil now. And here we are getting into the nitty-gritty of, no, is it? I don't think that's the correct expression, but the juicy parts, right? So let's call it that. So what happened to oil? So we were looking at this rejection at range low. Looks like it worked. In the sense that, you know, on Monday we gapped down and we kept on going down ever since, up until Thursday, Friday, we have this little bit of a bounce. And again, if you think about the entirety of this range, I mean, more or less, it wasn't perfect, of course, to the T, but we reached out into the, you know, farther out level of deviation. Right, so it was this one to the upside, right? Overshoot a little bit, right? And then it was this one to the downside. Now, bear in mind that, you know, even to the upside, we kind of missed, we came shy off of it initially, and then we overshoot. So nothing prevents the asset to, you know, getting closer to it, and then, you know, having a little bit of a bounce ahead of it, a little bit of a front run, and then really shattering through. We do have a gap in here, which was basically the gap from when the war actually began, I think, yeah. So can we feel it at a point? Yeah, I guess. So I think, you know, technically this is it, right? Played out nicely. As expected, with a catalyst of something like development in the quote-unquote peace in the Middle East, or at least what could resemble a peace or an agreement, right? But, you know, especially the reopening of the Strait of Hormuz, right? That's the normal reaction you would expect from oil. The interesting part, and I think most likely, at least, you know, I don't know for others, but at least for me, the hard part when it comes down to the forecast comes now. Because up until this entire phase, you know, how many times I told you, look, energy spikes, they are temporarily in nature because they create enough stress on the system. They create enough demand destruction over time, especially if they are applied on an economy which is not really performing very well on its own. I'm talking about the global economy, not, you know, specifically the US, right? But, you know, I was kind of, after the initial spike, the scare, and then a phase of normalization, and then we've seen these, right, an inability to keep on going higher. I mean, I was confident enough, right, decently, I'm not going to say I would have bet the house on it, but I was decently confident that this one would have been resolved with a move to the downside when potential agreements would have been reached in the Middle East. Again, everyone knew that at a point, one of the sides would have had to come to the table. So the difficult part comes now for me, because now you need to assess, and I'm not here to do that today, right? I'm just saying what, in my view, should be the process that you would need to follow. And then you pick your data, you pick your tools, whatever. But this is how I would do it. Now we need to assess if, this drop, of course, was driven by what? I mean, if you open back up the Strait of Hormuz, there is a lot of supply there just hovering above the sea level, right? All those cargoes and super tankers, right? They are stuck in there. Now they can finally come out and deliver their cargo of oil wherever they needed to be delivered. Okay. But the thing is this for me. Now, if everything will going to be permanent, right? And if everything goes back to normal, then again, sure, I would say oil may be coming down even more than this. I think it's going to come back down into the 60s, all right? The big risk, and which is what keeps me a little bit uncertain, is that a few things, really. First and foremost, it takes like what? It depends on the destination, but it takes from 15 days up to 40 days for a tanker, an oil tanker, to come out of the strait and get where it needs to be. It could be Australia, Japan, South America, whatever, China, right? Europe. Just put it like that. So what happens, since the agreement for now, it's 60 days of negotiations, right? You don't know whether if throughout these 60 days there will be actually a finalization of a peace, right? And on which terms, all right? So if it takes you, let's take the average, 20, 25 days. If it takes you 25 days to send a ship there, let's say from Japan or Australia, and then it takes the ship another 25 days to come back. If you are the owner of said ships, would you do this? Would you risk your fleet, once again, to be sent in an area of contention when you don't know how the situation is going to be in another month? And after, maybe you had a few of your ships already being blocked in there for 3 months now. I mean, it depends, right? It depends on what market participants and real actors in the real economy will feel about that. And then it depends on the insurance companies, right? I mean, the price of a barrel of oil, it's not just the oil itself, it's all the other contributors and all the other expenses which need to be sustained in order to, take that barrel of oil out of the ground, put it on to the supertanker, and then send the supertanker when it needs to be. So insurance is actually something which you need to factor in. So you may see futures actually keep on being stable at lower prices, but the spot price for oil, what about that? So, it's not just a matter of possibility of actually transiting a specific area or a waterway. It is also a matter of willingness to do that. So I don't know how it's going to be, right? I don't know, which is why I'm a little bit uncertain for now. And then again, you need to consider that although everything will be back to normal, a lot, I mean, not really a lot, but let's say part of that supply of oil, it's gone for at least a few weeks, if not months. Because, it's not a light switch. You can't just stop an oil well and then opening it back up with a flip of a switch. It depends on the well sometimes, but a few of them, not all of them, fortunately, but a few of them may be lost forever, right? And then you got all the infrastructures in the entire Gulf, like in the UAE, in Qatar, Saudi Arabia, being damaged and need to be repaired. So doesn't mean that production will be back at the same levels it was before the war, right? So that would be the story for, let's call it sticky oil prices, right? You're not talking 100, 120, but maybe a bounce back to 90 when the market starts to factor in all these things, right? That could be, right? That's what I'm thinking about. On the other side of things, there is the other part of the equation. What about demand? Well, we don't know yet because the data are lagging, of course, but we don't know what type of damage these shock actually did to the real economy. So we don't know the demand side of the equation. So it could also be that, sure, although, maybe supply won't be the same it was before. Let's say it drops 20%. Okay, so you should expect what? Higher prices, right? At a steady demand. And we know demand for these type of commodities is pretty much inelastic, sure. But what about, the damage which has been done is really too much and we are headed to a recession globally? It's going to be felt differently, depends on the part of the world you are living in, but globally, if you're facing a slowdown or recession and demand falls even faster than what supply is falling at the moment, what's going to happen to price? It's going to go down. So this is why I don't have a clear depiction of what it could be over the coming months. I would say we still have the possibility throughout the summer to see a few problems be reignited. But, again, same as for Bitcoin, I would say for now, let's take it 1 week at a time, right? Let's say that for now, bounce, wouldn't rule it out. But eventually, I would expect, more than anything else, I would expect oil to start trading in a range. And, the market would need to normalize after this huge and volatile move to the downside, right? So, we'll see. The problem is that it is also very headline driven. So who knows, right? But yeah, one thing when we look at this trade data would be this, which makes me think that the possibility for lower prices are still intact. If you look at the curves, right? So you look at the 3-month calendar spread, and then you look at it works a little bit like the yield curve at a point. It's just, if you think of the oil futures curve, right? You have different expirations and you have a different price for each one of them. So normally you would have contango in these commodities, and we are coming out of a huge phase of backwardation. For now, what really catches the eyes is that, a move so quick, which shifts the entire curve from backwardation back into contango. I mean, I think that's the market saying, you know what, we think that the demand destruction side of the equation will going to count more. Therefore, there is an economic damage which has been done, and we expect that oil will trade lower because the demand will be lower. Doesn't matter what's going to happen to supply, unless, again, we have another, closing of the Strait of Hormuz and war coming back up and, bombs and missiles start flying again. Okay, but if things go as planned, so agreement, straight open, it looks to me like for now the market is telling you that they expect lower prices, right? So again, we'll see about that. But for now, that's where I stand on oil. And I realize it's very complicated and it's not a clear answer. But to be quite honest, nothing ever is in financial markets. It's just a matter of trying to look at both sides of the story, not being caught up in a narrative, and try to come up with the best odds you can, play the game, manage the risk, knowing when you're wrong, and most importantly, knowing what may happen if you're wrong. If scenario A doesn't materialize, okay, then what? Scenario B? Are you prepared for scenario B, right? That's the game at the end of the day, right? So, it's useful sometimes to look at both sides, I guess. What about yields instead? Again, still seeing a little bit of divergence in this, because you see the 2 years made new highs this week. Yeah, sure, they did. And when? Probably Wednesday, of course. No? Okay. But again, the rest of it, if you look 10-year, kind of flattish. On the long bond yield, it kept on going down this week. So, this is what I think it's a flattener if you look at the yield curve. But I mean, actually, I think it would point more toward inversion. Or I mean, getting back toward inversion. Not saying it is inverted now, but essentially this one right here, right? No, this is the same as before. What was I looking for? I was looking for this one, right? So you see, you got the different maturities, right? And again, you see the 2 years in red, it's going up, but the others, they are staying stable, if not coming down. And then you look at the 2s and 10s, right? Yeah, it looks to me like the spread is narrowing, if anything else. So it's a steepening, not a flattener. Oh, I was wrong there. And how do you take that? I think if you start to put all the things together, you see oil coming down after, let's have a look at the daily time frame right here, okay? Being up for so long, you see yields diverging, not agreeing with each other. But I think what the bond market is trying to price in, it's basically a policy mistake, right? In the sense that they look at the labor data, right? Or I mean, let's frame it even better. The bond market looks at the Fed, especially after FOMC, right? FOMC, which looked at the labor market, which, if you remember, NFP, right? If you look at retail sales now, another part which may give you a little bit of insights on consumption, right? And then you look at the oil situation, which is kind of trying to normalize. I think the market is looking at the Fed, and they are saying, look, there is no way these guys are going to keep on dropping rates. If anything, they're going to keep them steady. But a lot of people on the committee are talking about hiking. So, which is why I think the 2 years is kind of pricing that policy mistake in. Why is a policy mistake? Well, because the rest of the curve, it's not agreeing with this, with the short end. It's kind of like, you know what? Is it possible that rates actually go higher because the Fed makes a mistake? And then they do realize over the coming months that it was a mistake, and they immediately revert course and they start cutting. So, which is why you see the short end of the curve going up for now, trying to reflect what the market think the Fed is going to do. But at the same time, pricing that in as a mistake because they think over a long enough period of time, this is not a story about inflation. And again, this is a time where we can bring in the break-evens, right? And look how much they tanked over the last 2 weeks. This is not a move you see every day, all right? Look at the 5 years, right? That's super sharp as a drop. Came back in line with the 10 years, right? So again, as I said, these massive delta, these massive discrepancy, this massive spread that you see from time to time, oftentimes, as we've seen in the past, it resolves with the 5 year getting back in line with the 10s. And if you look at the 5 year forward inflation expectation rate, it's flat. So this part of the bond market, as we said, again, this is nothing new. We were talking about it just, I think 2 weeks ago. This segment of the bond market is telling you, no, this is not a story about inflation being to 8, 10, 9%. This is not the 70s, right? Which is crazy because then again, you look at the Fed watch tool and it looks like the odds for a hike, they went up. I mean, almost 40%. So that lines up well with the 2 years going up, short-term rates, or I mean rates in general being higher in the short term, but then again, lower or at least getting back to the levels they should be in the medium to long term. So I think this is it when it comes down to what we are seeing in yields, and obviously conversely bonds for now. And this is the explanation when I try to put not all, but a few pieces of the puzzle together, right? I think this is just the market pricing in a potential policy mistake by the Fed. Now the ECB already hiked, right? And again, it's going to be crazy, but This is nothing new. We got the same type of talks and worries back in '08 when you see the central bank in Europe hiking rates in July 2008, just before Lehman Brothers went bust. And then they had to run for the hill and dropping it like a rock. And by the time the ECB was doing that, if you check on August 5th, 2008, FMC transcript, so this is what these guys were talking about, Mr. Lucky here, he was kind of thinking and reporting to his colleagues that the risk is too great that inflation expectations will ratchet up again. We need to be prepared to raise interest rates even if growth is not back to potential. So they were on the cusp, on the precipice of a policy mistake back then. They didn't at the end of the day, because of course then all hell broke loose, but they were talking about that. They were considering it. So I think, is it so naive to think that they are considering the same thing, looking at the same data once again, from, through these inflationary lenses, whatever, and they themselves, although the charts are on their own website, but they're not looking at it. They're not looking at what the market is pricing in. So, why wouldn't you follow what the market is telling you? Because it looks to me, if I look at something like this, which is basically the 2 years, right, yield, and then I look at Fed funds, which is the blue line, right? I mean, you have done it for so long in the past. Why don't you keep on doing it? You're just tracking the 2 years when it comes down to Fed funds, right? I mean, 2000, the 2 years starts to collapse, and the peak was when? May 2000, and it keeps on collapsing, and then Fed funds do what? Well, they waited up until October to dropping like a rock. And then again, you see on the other side of things, March 2004, the 2 years start to go up, and Fed funds is lagging by what? May. So, I mean, 2 months this time around. And here, they kept Fed funds steady up until the point, in June 2007, but the 2 years already peaked in June 2006. And it really started to go then. And then, they needed to understand that they needed to follow the 2 years. So the market. 2014, the 2 years start to come up, right? Steadily and, slowly at first. And then it kept on going. And, they started to track it, or they realized they needed to act in response to what the market was pricing in. When? In October 2015. But, the market was really trying to signaling from July 13. Although this time around, it's not the same type of magnitude that we've seen previously. All right. And then again, in here, 2018, the 2 year, it peaked in November 18, and it starts to go down, and they keep, actually in the beginning, they keep on hiking, although the market is signaling something different. Then they pause, and finally in June 2019, they decided to drop. After the pandemic, what happened? In here, you see October 2021, the 2 year yield really starts to go. And the Fed wait up until what? January 2022. So again, another 3 months lag before they decided that, the market is right. We are going to have an inflationary wave here. All right. So, and it's the same in here, right? 2 years, which peaked in October 2023, made a low, lower high, lower low. Finally, at this point, when even my mom would have understood it, they decided to cut rates. And now, we have the 2 years going up. So, could this be something like we've seen, let's say in here, right? We had this bounce, and they kept rates steady nonetheless, right? In '08. We had the same thing in 2002. where, uh, the market, they got a bounce, but they kept on dropping and kept keeping rates lower for a while. It would fit the pattern. I don't think they're gonna just overreact to these market fluctuation in here. I mean, it would, in being wrong, it would also be contradictory wrong, because if these times you waited so much before actually following up what the market was saying, why would you immediately react this time around? Right? So, we'll see about that, right? Now, after that, as promised, let's have a look for a minute at what Kevin Warsh had to say. Now, just two things, right? Just for the sake of it. Look, mates, for a laugh.
Inflation. First principles.
Okay, he's talking about the task forces.
For delivering price stability in a changing economy.
Obviously.
You'll hear quite a bit more about these task forces and this overall initiative in the coming weeks.
In the future.
Enough for now to make a simple statement.
Okay.
Each task force will serve an objective shared by everyone in the system.
Sure.
Shared by everyone around that table that I sat with over the last couple of days. A Federal Reserve that is clear-eyed about its mission, fit for purpose, and focused on the future.
That sounds great.
With that, I appreciate your attention. I'm happy to take your questions.
Okay.
Howard Schneider.
Let's see.
Hi, Chairman Howard Schneider with Reuters. Good to see you again, and welcome back. This is a lot to be putting in motion so fast. What is the timeline you have in mind for each of these?
So I think it'll depend on the task force. It also depends on the urgency in which we need clear answers.
So what's the timeline? Although, can't give you a clear answer, right? But it's just, it depends on the urgency. I mean, how urgent it's the matter of having precise data when we need to set up monetary policy? I would say every single moment, right? So, okay.
Expectation, I'm still in the business of recruiting and finalizing them. My expectation is the task forces will begin work in the next couple of weeks. And we'll start to get some more information from them, some more framing of how they see things starting in the fall end. Hopefully most, if not all of them, concluding by year end.
Yeah, right.
And just specifically on the inflation framework, you talk about first principles. Does this include a review of the 2% target itself? You've mentioned that things to the right of the decimal point don't.
Okay, so the question is pretty straightforward in the sense that, task forces, for whatever reason, data, communications, whatever approaches, clarifying the Fed and how it operates. Sure, you don't know yet how long it's going to take to bring them in and starting to produce effective results. Maybe a couple of weeks, maybe by year end. I'm still recruiting, whatever. And now the question is really precise. So with all this bullshit, will you also revise the way you calculate inflation as measured by the CPI in order to, maybe better fit the end result with your statements and appear much better at your job than what you really are, right? Let's hear out the answer.
Won't matter. Should this be starting from a premise that 2% as a point estimate is too strict?
Let me break that into two pieces. First, on the inflation framework review, their remit is what are the drivers of inflation? What's the Fed's responsibility for inflation? In part, how do we measure inflation? But that'll overlap with my data group. On the 2% inflation.
What are the drivers for inflation? I don't know, Kevin. I don't have a PhD, but I would assume it's just supply and demand. Or am I wrong? Since you don't do money because you don't print money, the commercial banking system actually creates money out of thin air. What do you have to do with money, inflation, and whatever? You're just reacting with what the market is doing, and you're just trying to keep up. And you can't because you don't have the tool to even measure what's going on in money supply. So let alone calculate all the rest. But keep on telling us how powerful and important you are. You and your friends there on the committee.
Objective. That is the Federal Reserve's long-held objective of 2%. You've heard me say before, I tend to focus on the left of the decimal point. Well, the 2 is the left of the decimal point. For now, 0 is to the right. I see no reason until we have reestablished our commitment and ability to deliver on the 2% inflation objective to revisit that. So that'll be outside the scope of what we're taking on.
Okay, so we have a target, but before actually talking about the target and if and when and how can we manage to obtain it, we should reassess whether we do have the capabilities or not. But just 1 second before, you said you have them. So how does it work? right? Okay, let's hear that out more, because the question which is posed after this one, it's still good.
Colby. Thank you so much. Colby Swift with the New York Times. You've in the past said that inflation is a choice, and in the policy statement, it includes this pledge to deliver price stability, as you've reiterated today. But looking at the SEP, the bulk of your colleagues expect core PCE to run around 3.3% by year end, and for the 2% inflation target not to be reached until 2028. So I'm curious how patient you think the Fed can afford to be at this juncture in terms of waiting for one-time inflation waves to wash through and for underlying inflation to step down after so many years of inflation running above target, and under what circumstances you would support the Fed taking some action and raising rates.
Sure. So quite a bit there. Let me try to break that into pieces.
Quite a bit there.
First, we have the capability and commitment to deliver on our price stability objective of 2%. That's exactly what we're going to do.
Yeah, sure. We have so much capabilities, and we are so powerful. Then the SEP, it's just projecting inflation or target, the 2%, to be hit by, well, modestly, And look, just because I feel like I don't want to be too overconfident, but in the much rosy type of projections, you should expect 2028. What? Almost 2 years? With all these powerful tools, with all these PhDs, it's going to take you 2 years to normalize inflation back to target? What the fuck? Where is the power then? I mean, which is basically saying, well, we hope the market will do the job for us, and then we will take credit for it. Okay.
In the Fed's review of its strategy over the last any number of years, in January, the Fed, including the strategy that we're still bound by, the Fed statement says that inflation is primarily determined by monetary policy. You bet it is.
No, it's not. Absolutely fucking not. Inflation, it's a supply and demand type of issue. It's not determined by what the fuck you're doing at the Fed or any other central bank. That you got two levers, right? Got interest rates and the balance sheet. None of those can actually impact what inflation is going to be, how money are going to circulate, how people will decide to spend, to save, or whatever the fuck, and let alone being impactful of something like what's happening in the Middle East. Do you think just because you hike rates, oil will start flowing again or being digged out of the ground? What the fuck are you talking about? You're mental.
Said for years inflation is a choice. You bet it is. And today I'm announcing that this committee unambiguously and unanimously.
It's a choice. Yeah, that's true. I mean, that's one of the few things he said, which is actually true. Inflation is a choice. It's by design. It's ingrained in the system. It's a debt-based system. It needs to be inflated away to keep on growing, right? But again, that's a topic for another day.
Have decided we are going to deliver on that. The rest of your questions sounded like an encouragement for me to give forward guidance. We dropped forward guidance.
Well, provocation, maybe.
Some along the committee, I think, dropped it, I suspect, from our discussion the last couple of days, because they said at this moment in time, it doesn't feel as though providing forward guidance is right. Others have, I'd say.
It doesn't feel right to provide forward guidance. Well, I think the answer is twofold there. Like, it doesn't feel right because you created an environment where for the last 20 years, the market, instead of being focused on fundamentals or things which actually matter, it's focused and hanging on every word the Fed is saying. So I would agree there that forward guidance should be dropped. But on the other side of things, I still think it's a nice cover to say, well, we are going to drop it because for 20 years we have said something and then we basically appeared like clowns. So at this point, maybe it's better to shut up instead of keep on talking and demonstrating how stupid we are. Yeah, that would make sense. That would actually be intelligent.
Different views and think as a general proposition, forward guidance isn't the business we should be in, but that'll be taken up by the Task Force on Communications and my policymaker colleagues. We're going to listen hard.
Wait a second. You are dropping forward guidance, but you established a task force for communication which will take care of forward guidance? How does it work? Okay, Kevin.
What the experts say and make our own decision. But I can't give you any forward guidance about what we're going to do next. The good news is we'll be meeting in 6 weeks.
So just following up, I guess.
All right. Yeah, that was enough. That was enough. And by the way, if you, I mean, you don't have to be a genius, right, to know that, but just take the less valuable AI model for now, which would be Grok, and just ask it, did the Fed manage to deliver on its inflation target of 2% over the last 20 years? it doesn't take a lot to explain that they couldn't. They were below target before. They have been around target for like 1 or 2 years, 2018, 2019. Then COVID came in. They went majorly below throughout the pandemic. Then they responded, or the government responded to the pandemic, and they went massively overshooting the target with CPI hitting 9%. And now we are dropping from that 9%, but we are still around what? Yeah, we came around 2.4 for like a month. And then we came back up to 3, and now we are at 4. And I guess next time we drop, it's probably going to be below 2. So what about these long-term average 2% target? How many times in the past were you guys able to actually deliver on it? Never. Zero. Nada. Yet. I mean, but all right, but they say central bankers are the most powerful institutions on earth. So who am I to say no? All right. So, okay, enough of that. Just a few minutes of jokes. So let's get back to the charts now. Let's have a look at the rest of the charts. And, you know, we're going to end up the video later on. So after that, a little bit of jokes and laughs, because one of my biggest mantras is that life is too short to be sad, and if you don't learn how to laugh, you're going to end up crying. So, you know, after that, let's review what went on in the stock market for the week, and, you know, let's wrap up the video. So the stock market was basically kind of flattish at the end of the day. I mean, if you look at the S&P, it closed pretty much near the weekly open. NASDAQ, a bit stronger, but, you know, it's not uncommon to see that. And, you know, the Dow, it's kind of the same of the S&P. So the market started out kind of rallying in the beginning of the week, like Monday. And then on Tuesday, we have a drop. And then Wednesday, especially with the volatility provided by FOMC going live, we filled the weekly opening up and we bounced off of it. So especially, you know, throughout Asia, we kept on drifting higher. The London session or the European session still overnight for you guys in the US, but for us, it was basically morning or midday. I kept on going to the upside. On, yeah, I mean, the rest of the day, at least for Thursday, it was kind of up only from there. And Friday was pretty flat, but, you know, it was an early close day because of Juneteenth festivity. So, you know, at the end of the day, when you zoom out, what you see is that, you know, the market didn't go anywhere this week. I mean, look, the Dow closed relatively close, near the weekly open. Same for the S&P. NASDAQ is a bit better. And yeah, even the Russell, which basically came back down for the majority of the week and then it bounced. So if you look at it from a weekly perspective, yeah, see very tiny body candle. And, you know, nothing else. We did also rolled the contracts. So we are now on September for the major indices futures. So, you know, I guess, you know, if you remember last week, but it's kind of different because it's a different contract, but structure is pretty much the same. Let's take the S&P just to name one. You remember we were saying, well, I mean, we could bounce from here, sure, but we have a little bit of overhead resistance now, which would be this one for ES futures. For the NASDAQ, we were basically looking at this point of release mainly, but you know, the old contract was a little bit different, especially this candle was a bit different, but I mean, you could still kind of try to do the same thing, right? So it's normal to have found a little bit of resistance at these levels. You know, on the other hand, the Dow, which was already on its way to new highs last week, it just made the new highs and then pulled back a tiny bit, but, you know, structure seems still intact. And same for the Russell, which, you know, actually opened higher on Monday, gapped up on a Monday, and then we came back down, and then it bounced on a Thursday and then Friday. So, you know, looks pretty much okay-ish still for now. The question now becomes, is this, especially on the two major indices, the NQ and ES, is this a lower high and we are, you know, sentenced for a lower low now? I wouldn't know about that. I would say for now, I would still lean on more bullish side of things for the stats, for the seasonality. So, and for the technicals. Like, I mean, for now, at the very least for now, you see that we're still holding these moving averages. They are still pointing upwards, especially on the Qs, right? The RSI, the stochastic, they are kind of in a neutral position. Maybe the stochastic, it's not. It's a bit more into the bullish zone. So, I would say if this is a lower high, it's going to be confirmed relatively quickly, right? So early next week, I would say. And if it's not, probably you're going to see new highs from here till the rest of the month. Now, don't forget, July, so next month, if we manage to hold here, next month of July historically is a month of positive returns. So the stats, as for the seasonality, should be there to sustain further upside. I would still say, even if, right, assuming the trend is still intact, which seems to be for now, we just held the retest at the 55 exponential moving average. Assuming it's still on the go for being bullish, I would expect it to be a little bit more on the grindy side of things. So probably not sharp moves to the upside, but a bit more of a grind higher, right? So, I don't think there's anything more to say about the stock market. It just gapped up, filled, and held for now. So essentially the opposite of what gold did. Right? See, gapped up, filled, bounced, and was faded. It's kind of what I was hoping to see on gold. So far, it's kind of happening yet. It's at least it's not negated in the stock market. So wouldn't be overly bearish. Actually, again, if anything, I would be neutral but slightly tilted to a bullish view. And that would be it for now. I mean, I have a few slides, but do we really want to look at them? Well, I mean, yeah, in order to highlight the risks, once again, if we look at margin debt as a percentage of M2, so in this case, it's just a way to measure leverage present in the system. How you can see, we are pretty elevated at levels which in the past preceded big downturns. Again, does it mean just because we reached into those levels and actually exceeded them, the downturn will come next week or next month? No, it doesn't. It just tells you that the risk-reward calculation is tilting a little bit against you, all right? But, a good old saying goes, the party always gets louder before the cops show up. So who knows how much is going to keep on going. So, yeah. And other than that, we had a little bit of a drop, especially at the end of May in retail flows. But again, might be just another thing. If you think about the end of May, where was it? It was basically in here. So probably the testimony that these rally in here was a little bit weaker and it was going up on a declining volume or conviction on the side of the buyers. But at the end of the day, with this dip, they came in and bought the dip once again. As you can see from later on, first, they're just going to highlight that now the yields, if you look at the yields of a 10-year treasury compared to the S&P 500 earning yields, right? Bonds start to be attractive. So it could be potentially, if you want to see it as a risk, it could be a drag on flows getting into the S&P because, you got a much better yield for quote unquote for free, right? Risk free. Again, although you would need to wait 10 years, right? Instead of putting money in the S&P and, collecting the dividends, so to speak. But again, I don't think the majority of people are actually putting money in the S&P just for, the dividends and therefore a yield of the S&P, right? So I don't know if it's really a fair comparison at the end of the day. I think both stocks and bonds, they have two different structures for a reason and they serve two different purposes, right? But, I think what we've seen after the end of May is this. So we had on that dip, flows actually coming back in, and therefore that would sustain my thesis of being a bit more bullish tilted for now, rather than saying, well, I would bet on a lower high here. I think I would put more odds on new highs in the short term, right? But maybe next week, maybe beginning of a new month. I don't know. But up until the point, you violate, especially these lows that you have put in, or you break again below the 55 moving averages in green. I don't see reasons to be overly bearish, right? Of course, a lot of the attention and the flows, consequentially, which were brought back in, was maybe because of the SpaceX IPO. I don't know. Surely, I mean, in these markets, with this speculative frenzy and all the rest, probably contributed a lot, right? But don't have the numbers in front of me, if not this one from Bloomberg, right? So again, this market could keep on going, and you see how, the concept of a mania, right, or a bubble, right, usually follows the same type of pattern, right? So it looks like we are now here, right? So smart money already bought. Institutions then bought as well. Now the media, it's catalyzing all the attention, and the general public, it's piling in. And, we don't know how long this phase will be, right? And it's kind of critical because, look, the thing is that the majority of the gains throughout a bubble are always materialized in the later stage of it. So if you get out now, sure, I mean, you may say, okay, I'm going to avoid the huge drop afterwards, but I'm also going to avoid the majority of the gains. So, which is why, again, at the end of the day, it's not a matter of being all in or all out. It's just a matter of being aware of the risks and manage them accordingly. All right. So it could be by trimming the positions when something is running pretty hot, or it could be raising your stop losses levels when something is becoming particularly extended, and therefore trying to retain most of the gains you made instead of giving them all back. But at the same time, being prepared to not ride the market down and waiting for the next bounce, right? Because what happens oftentimes is this, right? The market pulls back. Although there could be a scare, people may say, okay, you know what, I was in here, right? I'm going to wait for the market to bounce back to those levels, and I'm going to sell and de-risk my portfolio. And then what happens is that the market doesn't come back up to that level you were expecting, and it just keeps on dropping. And now you are basically trapped. And, sooner or later, either you live through all the correction and you end up giving back a lot of money, if not losing actual money, or, maybe you get out the very, most unfortunate time, which is when the market puts in the bottom. But this is just history at the end of the day, right? So, other than that, I don't really feel the need to go into a lot more. If anything, just, yeah, I mean, we just went through that phase of June where the market, historically, it's a little bit weaker than usual. And then after this phase, so after the end of the month, we should see the restart of a new month of July, and seasonality should be good enough for July. So again, another reason for me to keep on being relatively bullish this market, and nothing else really changed so far once we've seen this dip being bought, right? So after that, I think I'm going to cut you, well, not you, I'm going to cut the video here. I'm going to leave you off with that. I'm going to wishing you a very good weekend. It's so fucking warm here. I think right now it's like 37, 38 Celsius here where I live. So yeah, we are back in that time of the year where, spending a lot of time at your desk, it's not advisable because, pardon my French, but yeah, your balls start to sweat a lot. So it's better to spend time outside and doing something else, all right? To the most of your capabilities at the very least. I'm not saying you should never be in front of the charts, but, it's summer trading. It's like that for me. Lesser screen time, more free time. And curiously enough, results sometimes are even better than when you spend 5-6 hours a day in front of a monitor. So, might be a tiny piece of advice there, all right? With that being said, be nice and be cool. I hope to see you all back next week. Needs out.
The point is, ladies and gentlemen, that greed, for lack of a better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the essence of the evolutionary spirit. Greed in all of its forms. Greed for life, for money, for love, knowledge, has marked the upward surge of mankind, and greed, you mark my words, will not only save Teldar Paper, but that other malfunctioning corporation called the USA. Thank you very much.